So good afternoon, and thank you for joining us today. My name is David Talbot. I'm Managing Director and Head of Research here at Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on uranium today. We are going to hear from Peninsula Energy MD and CEO Wayne Heili. Now, during today's webinar, he will provide and go through to the mine plan, the outlook, give updates on the company, and then we'll take some questions. You can type your questions into the chat box at any time, and we'll get to as many as we can. Before we kick things off, first we need to discuss the fine print. During this Peninsula webinar, forward-looking statements may be made. I direct listeners to the forward-looking statements outlined on pages 2, 3, and 4 of its corporate presentation. That can be found on the website pel.net.au. Now, for Red Cloud Securities, I'd highlight this webinar is for information purposes only. It should not be considered a solicitation or recommendation to buy or sell securities. We note this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. So please see our most recent research located on the Red Cloud website for specific disclosures on Peninsula. Now, it is quite an exciting time for uranium and uranium equities. Uranium prices have over doubled since the beginning of 2023, particularly since the supply-demand imbalance was emphasized last September by the World Nuclear Association. Now, prices have hit another 15-year high, up to about $107 a pound as of late last week. The U.S. government has thrown its support behind nuclear power and the nuclear fuel cycle. It will be acquiring and funding the creation of Heili fuel, and the Russian uranium import ban is working its way through Washington. So there's also been unanticipated uranium production challenges in Kazakhstan and Saskatchewan, and these are further adding to the supply-demand gap. So with that said, why don't I turn it over to Wayne to speak about the company. Wayne.
Thank you, David, for the introduction, and thank you to Red Cloud for hosting these webinar series. It's a very timely moment to talk about uranium and talk about up-and-coming uranium producers and production centers. As the audience is probably well aware, Peninsula Energy is one of those. We're poised to become a mid-tier uranium producer in the coming months. Peninsula Energy is traded on the Australian Stock Exchange under the symbol ASX. We also trade on the OTCQB markets under the symbol PENMF. So what I have on this cover page, I'd just like to take a moment to talk about the picture so that you get familiar with Peninsula Energy. Peninsula is a brownfields project developer. Back in 2015, Peninsula Energy licensed and constructed the facilities that you see here, which are in the foreground an office and shop building, but in the background our what we call in the industry satellite plant. We have a facility that we're capable of producing, capturing uranium on ion exchange columns and on ion exchange resins, and then transporting those resins off to a third-party processor. I highlight the building in the background. It's about a third of the size of what a central processing plant would be, and in a central processing plant, you'd have the capability of removing the uranium from the ion exchange resins and to produce a dry yellow cake product. The reason I highlight that is because Peninsula today is in the process of preparing our central processing plant. We're going to be breaking ground very soon on the construction of the central processing plant, and we'll be expanding the front end, the satellite plant facility, the ion exchange section, to go from what is presently less than 1 million pounds a year of production capability of uranium to bring it up to closer to 2 million pounds a year. So it's a very exciting time, and 2 million pounds a year from a single project, that is a mid-tier uranium production project in North America. So we're fully funded for that at this point in time to bring the project to and the construction efforts to completion and to put the project online, hopefully before the end of 2024. So I like this picture for that purpose. You can understand the context that First of all, at Lance, our flagship property, we have the facilities and the licenses, and we previously produced. Our ambition now is to expand the facilities to become fully independent, to be able to produce yellow cake from our facilities, and yellow cake being a saleable product in the uranium market, the U3O8 that we talk about in pricing. Just a couple of disclosures. I'd encourage you to look at our corporate presentation on the company website, and to familiarize yourself with the disclosures, the competent persons and disclaimers, the fact that I sometimes use forward-looking statements. I certainly will in this presentation. There's so much to look forward to in 2024 for Peninsula, and a note about the fact that we sometimes utilize inferred resources in our project economics, but I'll highlight that a little bit more. Today, Peninsula Energy has a world-class uranium production asset. The state of Wyoming, and it's state of Wyoming is a tier 1 mining jurisdiction. We have past uranium producers, current uranium producers. Peninsula, all located where Wyoming's a self-regulated state. We don't have direct regulations from the federal agencies like the Nuclear Regulatory Commission. The state takes care of oversight of the uranium mining and radiological safety aspects. So we're really pleased to be working in the state of Wyoming. We are a near-term producer, and I think that's a significant takeaway for everybody involved. We have multiple avenues of growth, and I'd like to highlight that during this presentation. Of course, David's pointed out already how favorable the uranium market dynamics are today, with production shortfalls being announced from many of the major players, right on down to just the fundamental supply-demand shortfall of supply. The uranium markets have taken off in the second half of last year, reaching multi-year highs, 15-year highs, really. It's an exciting time to be a uranium producer and a company ready for production. We are funded to production, and I want to share with you our plans for 2024 and what you can look forward to from Peninsula Energy. So today, as a corporate overview, again, a stock trading on the Australian Stock Exchange. Our market capitalization is around $288 million Australian, 14-cent share price, about 2 billion shares on issue, which is not so uncommon in the Australian markets. We have about 400 million shares of options out after our recent capital raise, which I'll talk to in the next slide. Those options have a strike price of 10 cents, and we're currently trading at 14 cents and have been moving upwards. So, the options are in the money. We feel that revenue will come to us in the course of the next year. I'll talk about that. At the end of December, we had $17 million US on hand, and then we completed or closed a placement in January of this year. So we're really cashed up. Next slide again. I'll feature the capital raise / placement that we completed. We have no term debt, and that leaves us in a financially very solid position. So the equity raise that I was just referring to, in November, we announced that we would be doing a placement, raising 50 million Australian, less fees, and we received that. That placement was successful, and we received the proceeds of that on January 15th. We also just completed a 10 million Australian share purchase plan or securities purchase plan, and we received that money at the end of January. So with the income completed now, 60 million Australian additional funding from the end of the year, that brings in about 39 million US, which means that the company today sits with north of $50 million US. Again, the placement terms were 7.5 cents a share, with a half option attaching at 10 cents. And the share purchase plan had the same terms given to our existing shareholders. We were heavily oversubscribed. but we stuck to our commitment to the shareholders, which was a $10 million placement. So together, the options from the placement and the options from the share purchase plan mean that we could see an additional income of about $40 million Australian out of the options in the coming year. The options are relatively short duration validity, about 14 months. So a good opportunity for the company to see additional revenue through the approved and issued options. Our management team, our board of directors, a very experienced uranium team. It's one of the highlights for Peninsula. We have real depth in construction and design and operations of uranium projects in the United States and really around the world. We've had a number of our team members who've worked in Kazakhstan, who work in Australia, familiar with those projects as well as our own. And most of us have come from other North American and U.S. operations. I myself, with 35 years plus of a career in the uranium mining industry, it's really all I've ever done. And it's what I know, and I love the team that's under us, or me, and supporting me in the endeavors of moving Peninsula forward. We also have a focus as a team on sustainability. We've now issued two annual sustainability reports, and one of the highlights of that, I think, and a mark of a good company is our commitment to safety and the fact that we've actually gone over 6 years now at our project site without a lost time accident. That's a very significant achievement for the team. We've received the Wyoming Governor's Safety Award 2 consecutive years, reflecting that commitment to safety. We've also gained our ISO 14001 and 9001 certificates for environmental and quality management, and those are important to our customers, the European utility community in particular. And I think we're the only U.S. uranium, the only U.S.-based uranium producer with those certifications. Let's talk about now the project. Our flagship project is called the Lance Projects, and it's in the state of Wyoming. The Lance Projects are really, it's plural because we've subdivided into 3 separate areas. We have a production area, a development area, and really an exploration area. And this is what's significant. It portrays the upside of the project. Today, the Ross area is fully developed and licensed, and that's where the plant facilities, which I showed you on the cover slide, exist. It's fully licensed. It's home of those facilities, and it has a remaining resource of about 6 million pounds. We have 2 previously operated in situ recovery well fields, Mine Unit 1 and 2, and it has the potential for 2 or maybe 3 additional well fields. Today, we're developing Mine Unit 3. And it'll be available for us when we restart the project towards the end of this year. Then we look outward and say, what sequentially will we do next? And we look to the Kendrick production area or development area. Kendrick has another 16 million pounds of resources. And we currently have the applications, the amendments for Kendrick to be brought into the production area, the production licenses and permits. That regulatory review's been ongoing for over a year now. It's typically an 18-month process. I'd like to think we're still on that schedule, and that means that during the course of this year, one of the sources of news flow that is not particularly highlighted anywhere else is that we should be gaining the license for the Kendrick area, and it'll move from Kendrick development area to the Kendrick production area. Together, Ross and Kendrick are the 2 areas in the Lance project that we've assessed in our life of mine project primarily because the resources there are heavily measured and indicated, and only a portion of them, a small portion of them, are inferred resources. And when you're doing project economics, it's the best choice is to stick to your higher quality resources, you're measured and indicated. That's what the codes and systems that we work under generally prescribe. So let me tell you about the Barber exploration area. That's the area in green. And you can see, together, this collectively is a district scale project spanning 37 kilometers north to south and 8 kilometers wide. But Barber represents our, under delineated resource area. We have actually several thousand drill holes across the Barber area, but it's generally characterized as wide space drilling. We're able to define roll fronts and mineral trends, but we haven't narrowed in on them with close space drilling. Therefore, the resources there are predominantly characterized as inferred resources. We have about 32 million pounds of inferred resources within the Barber area. And that's an area where, with additional drilling, we believe we can greatly expand the uranium resource on the project and take this from what today is 54 million pounds and one of the largest uranium projects in the United States. We could take it up over 100 million pounds with additional drilling. I have another slide that I'll share with you. Again, very forward thinking, and this is an exploration target, but it represents the potential for Peninsula to become not just a mid-tier producer, but maybe a larger producer in the future. Today, we have the plant and wellfield facilities at Ross, which were constructed back in 2015, so they're relatively modern. In fact, it's really one of the newest constructed uranium production facilities in the United States. It operated from 2016 to 2019. We've recently, and we've been working on this for a long time, but completed the site transition to become a low pH in situ recovery operation. The low pH in situ recovery is practiced in Kazakhstan, Australia, and other countries around the world. And those are really the low cost uranium production leaders. We've long thought that would be a good way to go in the United States, but Peninsula took the initiative to become the first company to adopt the low pH chemistry rather than the alkaline chemistry. Again, that's fully licensed. Now we're permitted to do that. We've transitioned our site so that it can operate as a low pH facility. Current capacity is about 820,000 pounds a year, loaded on ion exchange resins. As I explained, this is a satellite production facility. But we have plans, and we're beginning to get ready to break ground on the plant expansion, which will expand both the plant capacity, taking it to closer to 2 million pounds a year, and the capability, allowing us to take the loaded resins and produce dry yellow cake at our own facility. So that'll happen during the course of this year. We're funded to do it, and the engineering work is essentially complete. We have bids out for construction firms, bid packages out for construction firms. We've been doing quite a bit of the procurement of the equipment. And like I said, I look forward to getting the ground broken and the process started of the construction in the very near future. Concurrently, we're developing the new Wellfield Mine Unit 3, and we have 7 drill rigs active at the site putting in new well fields. The picture on the top here shows what an in situ recovery well field really looks like, and the little black spots in the picture are boxes that cover injection and recovery wells, and the 2 wells in the foreground really are monitor wells that sit outside of the production area, but we monitor the groundwater quality at a distance from the well field to make sure that we are fully controlling the groundwater that we affect during the mining operations. Of course, in situ recovery in the United States, groundwater requirements are that you restore the groundwater to its original class of use, and we're looking at not only monitoring it during mining, but also the necessity and the ability that we have to restore groundwater in the future. So moving on, this slide now really talks back about that exploration upside that we have at Lance. The geologists have set an exploration target of 104 to 163 million additional pounds, and that's based on first past exploration results in which we've defined more than 300 kilometers, linear kilometers of redox fronts, which are mapped here in red. And the trends move from north to south across the entire property where we hold mineral rights. Only a limited amount of close space drilling has been done on the Barber area, particularly, and Kendrick. We've done quite a bit more now, but fronts defined by wide space drilling are really mapped linearly, like you see here, due to insufficient amounts of data points. Wide space drilling can define an inferred resource. The true sinuosity and dimensions of the uranium mineralization, the redox fronts as we call them, can only be understood by closer space drilling. And when you do that closer space drilling, our experience at Ross and at Kendrick was that we've seen expansions of the resource in 3 to 5-fold sometimes, and that's the basis for the exploration target. With 32 million pounds of inferred resources on Barber, if we have that type of success moving into Barber, then the potential is there for another 100 to 160 million additional pounds. Imagine, Peninsula with a 200 million pound resource and a mine life that's not 30 years, but 40, 50 years. It's a tremendous opportunity. It's a great world-class mine. We've also introduced late last year a new project called Dagger. Dagger is about 20 kilometers as the crow flies north of the Lance Project facilities at Ross. Dagger has an initial inferred resource of about 7 million pounds, 6.9. And what's exciting about it, first of all, the grade is considerably higher than the average grade across the Lance projects. It's about twice the average grade. And the drilling database that we've acquired and have knowledge of suggests that the drill hole spacing is close enough to classify this resource as measured and indicated. But the reason why we've classified it as inferred initially is that we have not put drill rigs on it when we established the project area. So part of our 2024 plans is to go and put drill rigs on the Dagger project and upgrade the resource from inferred to hopefully all measured and indicated. We believe we can do that with a relatively small drilling program, confirmatory drilling program. What else is that I really appreciate about the team that's behind Peninsula, and this is a true reflection of that team. We were able to establish the Dagger project. Mineral rights, data that collected the data for only about $800,000 US, and with a 7 million pound resource, that means our cost for establishing this project was on the order of 12 cents per pound in the ground. And everybody knows valuations on uranium projects are, 2, 3, 4. Some, good projects are selling for $6 to $10 a pound. We spent 12 cents a pound. I don't think the market's really taken this into account. But there it is for you folks. This is one of the up and coming projects. We think we could put a satellite facility, which is, a plant similar to what we currently have at Ross, up at the Dagger project, ship resin to our new central processing plant, which we're building this year. And it might be an avenue for us then to increase production rates from 2 million pounds a year, which we'll achieve at the Lance facilities, and bring maybe another 1 million pounds a year from Dagger down to the project. So as a company, bring our production rate up to 3 million pounds a year, which happens to coincide with our license approvals for the Lance projects today. So looking ahead, we have this construction project, which will take us through most of this year. It's funded, but we're also, sharing with the audience what our life of mine model looks like. We think that with the facilities that we're building this year, we can be in production in early 2025 and ramping up production throughout the course of the year. We could produce over 1 million pounds in 2025, taking that up closer to 1.8 million pounds a year and later in the decade. Again, the license is for 3 million pounds a year. The facilities that we're building, the front end, the ion exchange facilities will be rated for close to 2 million pounds a year. The back end plant is going to be almost fully capable of 3 million pounds a year. We'll probably need to add a product dryer if we go to 3 million pounds a year, but we're leaving space and accommodations to do so. So we're getting a plant ready for 3 million pounds a year, with the front end being 2. And as I noted in the Dagger slide, the possibility of bringing resins from offsite or maybe in the southern portion of the Barber projects up to the central processing plant for finishing. The exciting part of this is that we generate positive cash flow within the first year of operations. That was assessed when the market was $60 a pound. Today, with the market at 107, that's even more true. Peninsula Energy is an existing company. We have a long history of delivering product to our customers. We've actually been delivering uranium to customers every year since 2016. It's a little known fact about Peninsula is that we've been active producing in the past, participating in the markets and fulfilling contracts. We have a sales contract book that represents about 1/3 of the projected life of mine production from the project, which I just shared with you. The charts, the sum total of production from the Lance, Ross and Kendrick areas was about 15 million pounds, and today our contract book represents a future deliveries of about 4.8 million pounds. That contract balances both base price escalated pricing mechanism and some market pricing mechanisms. It provides us protection from the downside pricing, which we enjoyed over the last 5 to 8 years. It also gives us very good leverage to the upside and linkage to the uranium spot price. As you can see in this chart, again, a chart that we prepared in August of last year, but today it looks a little outdated because the high end of the chart is about $100 a pound and the prices have pushed past that. You can see that the average realized price for the company using our contract book and open and the non-committed pounds moves very well with the spot price. We have great relationships with our customers. We've built them over the past 8 years, and they continue to be very supportive of us. One of the questions that we were faced with last year is, if the price of uranium, the spot price goes up like this, are you going to be stuck in a position where you have to buy pounds and deliver them to your customers? The answer is no. In 2024, our customers have worked with us to flex the delivery schedule to move deliveries out. Since we're not really expecting to have any production in 2024, our customers do not expect any deliveries next year. We are not exposed to the requirement to buy in the market and sell into contracts in 2024. We expect to be producing in 2025, and from there forward, be able to fully satisfy this contract book. So the company is today in a very good position with its customers and in relationship to its contract obligations. And as we know, and David mentioned, the uranium price just continues to move upward. We've updated the chart to show the $107 that it achieved last week. This is a post-Fukushima high for the markets. Once in operations, the Peninsula will be well placed to benefit from this growing market. We're excited about the market today, the tailwinds they're carrying us through 2024 as we prepare our project for production, and the prospect of having a very profitable and positive cash flowing project, by the middle to late part of 2025. So this is it. This is what we're going to do in 2024. These are the things you can look forward to. We have some remaining funding needs really to carry us from first production to the point of free cash flow. We have a sufficient amount of funding on hand to get us to first production. We're looking at debt structures. We're looking at a lot of different structures. Excuse me. Of course, there's plenty of opportunity in the equity markets, but we were just there, so we're not in a big hurry to get back into the equity markets today. What we're doing in 2024, we're going to be initiating plant construction and subsequent progress reports will be coming into the market. We're going to complete the development of our new mine unit 3, and other production areas will be initiated. We hope to do some resource expansion drilling at Lance and plan to do so at Dagger. Again, that's going to depend on availability of funding and drilling rigs. And then, finally, and the highlight for 2024 is when the production plant is nearing completion, we're going to commence uranium production activities at the site. We're going to start preconditioning the well fields, and we're going to get ready to go into 2025 strong as a well set up uranium production asset. So we have the flagship asset in Wyoming at the Lance projects, capable of growing in size and scale with good execution of the plan. We have a very robust production plan with operations starting in late 2024. The ability to expand our production profile. First, we're doing that. We're bringing it to 2 million pounds a year, but then more importantly, we're no longer relying on third-party processors. We'll have early positive cash flow once we're in production. And all this is being done by a well-respected and highly experienced uranium team. So with that, I'm going to stop and open up for questions. Thank you.
Great. Thank you very much, Wayne. Great presentation as always. So we are now going to kick off the Q&A portion of today's webinar. Reminder on the line that you can type your questions into the chat box at any time. And Wayne, we do have a couple questions here already. So, you're poised to become a midterm producer in the USA, but, this is a global industry. Do you have any clients outside the US? And what do supply shocks in other jurisdictions, such as Canada and Kazakhstan, do for Peninsula in the US?
Well, yes. I mean, first and foremost, our assets are in the U.S., and we do have customers, represented by significant and major U.S. utilities. We also have European utility customers. So Peninsula has reached beyond the U.S. markets with respect to its marketing endeavors and has been successful. Uranium is a global market, and the commodity is easily transported and fungible. But we'll produce the uranium in the United States, and we're able to sell it around the world. And all of our customers are certainly global. Not just U.S. but global nuclear utilities. The markets, with supply shortfalls in Kazakhstan. And really the prospect of uranium import bans here in the United States from Russia means that the United States markets are stronger and more open and embracing U.S. domestic production. The U.S. government is looking at incentivizing U.S. production, not just of uranium, but of course conversion and enrichment, the nuclear fuel cycle as a whole. And they're putting their money behind it, with about $2.7 billion now being proposed in the Senate bill, which is being debated presently this week. So there's a lot of money, government money and government support in the United States for expanding nuclear, and a lot of support for nuclear. But when you see shortfalls in global, and major companies not making their production targets, in an already tight market, what it means is there's a bigger place in the world for mid-tier producers, for companies like Peninsula.
Mm-hmm. Okay, great. Thank you. Now, Peninsula was involved in the sales of to the U.S. uranium reserve last year. I want to say offhand, I think it was 100,000 pounds or so from Peninsula. Do you anticipate that to happen again, or what's the U.S. planning for this year?
We did. I think we sold 200,000 pounds at the time at the outstanding price of somewhere around $60 a pound. Today you look at it and you say, that was very supportive at that time, because the markets were closer to $40 when the government agreed to those purchases, and it really helped support us in moving forward. The U.S. government is looking at incentivizing additional uranium production through its funding bills. The form of incentivization may not be direct purchases from the producers, especially when the market's strength is so apparent right now. We can all, pretty much everybody in the U.S. who has an ambition to produce uranium, including Peninsula, all produce at a profit in today's market. So a direct sale to the government isn't as supportive today as it would be. I think we can all find customers who are looking for uranium. So, the forms of incentive that uranium miners need from the government now are continued support to grow the nuclear fuel cycle, commitments to U.S. sourced material in the programs that they're developing for the development of high assay, low enriched uranium and other conversion techs. But let's source it from the United States, and if that means the U.S. government buys it and sends it on to the converters and the enrichers, that's good. But right now there's nothing directly on the table that would suggest the government is going to conduct another round of buying.
Okay. Now, with the spot market at $107 a pound, is there a changing tenor of your conversations with nuclear utilities? Are they clamoring for more secure sources of supply? And with, you almost have 5 million pounds contracted out right now, would you consider further offtakes?
Yes. To the second question, yes. We would consider further offtakes. Anytime you have the opportunity to strengthen your sales portfolio with higher price contracts, you really need to consider it. I've always regarded that a company should have contracts that cover sales contracts that cover their base costs. And at a third of our production being committed into future contracts over the next 10 years, by the way, we're approaching that, but we're not there. So additional contracts, at today's pricing and or higher, would be a very attractive addition to the portfolio. So the first question was really, are the U.S. utilities clamoring, or are the utilities clamoring today for, piece of the action with Peninsula Energy, I guess. And the truth is we've had very productive and fruitful conversations with U.S. utilities, and other global utilities. And I respect them as being very good planners. Just because the spot price is $107 today doesn't mean that they're the ones pushing the price up. In fact, the utilities have tended to back out of the spot market because of the higher levels. And, they can wait it out. To a man, I think every utility has their 2024 needs met, right? They don't have to go in the market when the price is high and buy and panic buy. They don't. You don't see it. But the market is supported by the long-term supply-demand fundamentals. And in the long term, the utilities tend to be active in the markets every year, picking up another strip here or another strip there. And that's where the business will be for Peninsula in 2024. And, the opportunities is really for us to pick up some additional strips of long-term contracts at better pricing than the ones we currently have.
I think it was really telling last September when the World Nuclear Association came out and said, not everybody that needs their pounds will get their pounds in coming years. So that I think that says it all. So, Okay. Now you have sold production forward, as we've talked about, and you had a graph showing that you have exposure to rising prices. So what attributes do you have in your contracts? Are you exposed to spot prices? Do you have escalation clauses, floors and ceilings? What's the mechanism behind your contracts?
Right. Well, part of the fundamental exposure to the rising market that we have is that 2/3 of our production, our future production, is not committed to contracts. So that's fully exposed. 2/3 of our future production from just the Ross and the Kendrick areas, not the Barber area, is committed to contract or is open to the market. But in our contract book, there is a balance. There's a balance between base price escalated contracting and our market structures and our pricing structures and market-based pricing structures. Now, just on the base price escalated, most of the contracts from the past had either fixed escalators or escalators tied to inflation. So we just came out of a period of extreme inflation, and some of our contracts, quite a bit of our contract with the base price escalated, we're escalating with inflation. So that covers us against the rising costs, is that we also have rising revenues. But that doesn't reflect in that graph because, we can only make an assumption about what inflation would be in our price projections. We don't really know until it happens. The second part is, a portion of our contracts are market-based. And what incentivizes a utility and what incentivizes a producer to sign a market-based contract? Generally, for a producer, it's to have a floor that protects you against having to sell at a price that's below your production costs or expected production costs. And for the utility, it's to have a ceiling, a price that protects them from runaway markets, periods like today. So, if you would have written a market-based contract a year ago, the ceiling might have been $60, $80, the ceiling crept up closer to $80 in the second half of last year. Today with a spot price over $100, I don't really know that we know what the ceiling is. I don't know that anybody's expressed what the ceiling is today, but there's a lot of consideration for what a ceiling would need to be in a market related contract signed today. So the contracting is kind of at a pause as the market is very volatile at the moment. The utilities will come back in and meet their contracting needs in some point in time in 2024 when the market stabilizes, and we'll all get to know and familiarize ourselves better with the new market, the floors, the ceilings, the base prices.
Right. Okay. Now, last summer, Peninsula needed to pivot from toll milling elsewhere to finishing construction on your Lance processing plant, which was sort of your plan all along anyways, just maybe not doing it so quickly. What are the benefits of really controlling your own destiny there, bringing all the processing in-house?
Well, yeah, we were prepared to start production last summer. Really, we have the current plant in its current configuration ready to produce. We have Wellfields in their current configurations ready to produce. So, we were at a stage last summer where we were just about to press start and be producing. And that hasn't changed. We still have a facility that in its current configuration could be producing uranium today. But as you said, we pivoted. We were rather forced to pivot because the company that we were sending our resins to said, they want to reserve their capacity for themselves and they didn't want to share it with us, a competitor. So we pivoted and we went about, updating our life of mine production plan so that we could become an independent and uranium producer. Spent some time on that. In the second half of last year was a challenging time for Peninsula Energy, honestly, as we were making that pivot. But we came out with a very solid plan. Some of the advantages are, well, you're no longer relying on folks who've proven they might not be so reliable. And secondly, you can do it yourself for a lot less money than you would spend paying somebody else. Now, what does that mean? That's probably $5 a pound, or maybe even closer to $10 a pound in today's market, savings by doing it ourselves. And that's significant, especially when we're doing the evaluation of the markets were $50. And if you can save, $5 in a $50 market, that's significant. So we've capitalized that plant construction. We have the plans developed to build it, and we'll be starting construction in the near term.
Okay. Is there anything you can say as to why the toll milling agreement was terminated?
No, I think I've said it already. I think they were saving their capacity for themselves and questioning why they were committing their capacity to a competitor.
Okay. Now, how do you keep track of the building process, to determine if you're on time and on budget? When do you plan to finish the plant? What are the milestones you need to hit this year? What's keeping you on track?
Yeah, well, with the engineering work at a stage now where we can put out bid packages for construction firms, this is a crucial point. We expect to have construction firms coming in with their bids, in the very near term, and we'll have a really good idea if the assessments and analysis that we put together in the second half of last year, still holds. I think it does. One of the benefits for Peninsula is that our cost projections and our capital projections are just updated in the middle of 2023. We probably have some of the freshest, feasibility study level cost analysis of any of the uranium producers. So we stand a better chance of not having a miss on cost overruns. We're also had a sketched out, timeline, and we're keeping to that timeline today. We think the construction can be, 8 months or thereabouts, and our objective has been stated that we get the project running before the end of this year. Since it's just now at the end of January, we're 11 months, and it feels realistic. Even if construction goes 10 months or what if it takes 12 months, we're still in a very good position to meet all of our contractual delivery obligations in 2025 and beyond. So even a small miss is not going to be catastrophic for us. It's just going to be a re-guide, but we don't want that to happen. So, I recognize that 2024 is the year that, the largest risk in front of us is construction risk, time and budget, maintaining them. And, our team is right on top of that, tracking against expectations and keeping the project moving forward as fast as we can.
Okay. And you're fully funded through production at Lance at this point. So
That's right.
Yeah, you raised $54 million. You have other cash coming in, like you said in your presentation. So I believe you expect $90 million capex on working capital that needs to be covered. So I guess how much remains to be covered, and how might you fund that?
Well, right. So at middle of last year or the end of August, we guided that we thought 95 million US was the number that would take us to the point where we're at free cash flow positive on a sustainable basis. Now, today we have somewhere in the mid 50s millions in the bank. So maybe there's a $40 million gap. That plan is, the optimal, most excellent operating plan for us. Okay. There are ways to economize if the money wasn't available. But our plans right now, fulfilling the gap, is we're looking at debt facilities from commercial banks, the U.S. Department of Energy. There's a debt facility we believe we'd qualify for. We have some application work pending, and we'll know more about that. But we'll look at quite a few opportunities. Again, the equity market is very buoyant for uranium stocks right now. And although we just raised money in the equity market, that doesn't mean that there's not more opportunities being sent our way. We haven't excluded anything. We've said debt's kind of our priority. Equity would work. For us, we're not dropping our pen. We're gonna continue to work on getting that additional funding so people can and investors can go to bed at night knowing that Peninsula is funded through to first positive cash flow, and that we could be a self-sustaining uranium producer in late 2025.
No, sounds great. So, and production will take a little bit of time to ramp up as well. So what does your production forecast look like for this year, but I guess more importantly next year in 2026?
Right. And there was a chart in the presentation, minimal production in 2024, but that doesn't mean we won't start production activities. We'll actually, mine unit 3, which is going to be the first unit built for low pH operations, should be ready for some of, portions of it for preconditioning in the third quarter of this year. And if our plant construction's on track and we have a line of sight to the completion of the plant construction, then we'll start preconditioning the well fields in the third quarter of this year. It'll be part of our news flow. And when we turn flow to the plant, what we'll have is a very strong production profile from the get-go, because we'll be putting Wellfield solutions that are containing uranium straight to the plant, and we'll be producing uranium from day one. So 2025 looks like it'd be a very strong ramp up. We have the benefit, if you will, of extra time. As we build the plant, we can get everything else ready to go. And we're planners. We're good at that. We know how to produce. We've done this before. So we're getting everything ready. Our plant in its current configuration and our current well fields are ready to go today. We're just not going because we have no home for our loaded resins. And, when we have that home built, we'll be going in 2025. Looks like we can produce north of 1 million pounds. And, 2026 will go to 1.5 or 1.4. And we'll be moving towards that 2 million pound a year, range, towards the end of this decade.
Yeah. Maybe elaborate a little bit on that Wellfield number 3, we're talking about. You're going to build a brand new Wellfield here. It's going to be fresh. Why is that better than restarting Wellfield 1 or 2, which are ready and built and have produced?
Because the grades coming out of a fresh ore body are going to be significantly better than the grades coming out of a previously mined Wellfield. Wellfields 1 and 2 were operated in the alkaline chemistry 2016 to 2019 timeframe. And 40 to 50% of the uranium has already been pulled out of those wellfields. So, when we go back in with the low pH solutions, the potential grade is just not going to be as high as long. So it's going to be great to start with a fresh well field. Look, if we had started last year, we would have started in the old well fields as we were preparing mine unit 3. Now we have the opportunity, the optionality to start a fresh mine unit. That's going to give us more strength in production early on. That's what we'll do. We'll use the old well fields to supplement our production. To bring additional pounds into the plant when we need them, and we'll activate those areas which have been prepared, but not acidified, not conditioned. We'll do that as needed to supplement production, and again, that's going to be part of the strength of our operating scenario, is that we're going to have areas to fall back on. We won't be constantly waiting for the next area to be developed.
Yeah. And that's all part of your plan to get to 1.8 million pounds a year from the Ross and Kendrick areas. What would be required to prepare the Barber resource area in order to support further expansion to maybe 3 million pounds a year?
Well, first, we'd have to include the portions at Barber that we want in our production licenses. As I went and pointed out during the presentation, we're presently permitting the Kendrick area, which has a known resource of about 17 million pounds. We're bringing Kendrick into the licenses. You have to do all of the baseline environmental studies, hydrology, vegetation, soils, everything. And that's a very large area. So it's a district scale project. So, if we wanted to bring Barber in, we need to get those baseline environmental studies completed and updated and put in front of the regulators. So that's it's a couple of year process, 2 to 3 years. Barber has a need also for closer space drilling, to define the best areas to target for initial production. So, we're looking towards putting drill rigs out on the Barber areas in the coming years, maybe this year, certainly 2025. But with a resource already of 22 million pounds and a production plan of 1.5 to 2 million pounds a year, it's going to be a while before we actually need Barber in that production scenario.
Yeah. Okay. And I guess that, goes into M&A activity. The Dagger Project, I think, is the first Wyoming acquisition that I can recall since you started developing Lance. Are there any other deposits nearby in Wyoming or even across the border in South Dakota that makes sense to procure here? With up to 163 million pounds of exploration potential, you already have a lot on your plate right now.
Yeah, we do have a lot on our plate, and it's interesting to me. I think Peninsula has been kind of pigeonholed as a one-trick pony. We have one project, but when you see the presentation, you realize what we have is a production project, a development project, and 2 exploration projects now, all in one neighborhood. There's nothing wrong with that because it's a tier 1 jurisdiction. It's a great place to do business. Now, can we spread out? Can we look at other, compatible and good projects? You bet. Because Peninsula can and will, grow beyond the 2 to 3 million pound a year production rate. But we like to put one foot in front of the other. We're going to start with getting into production. We're going to do that right, and then we're going to do the next part right. That is to continue to grow the company. But at Lance and the Lance projects, with a potential, an exploration target of 100 to 160 million pounds, we don't have to look too far.
Okay, great. Wayne Heili from Peninsula Energy. Thank you for joining us today.
Thank you, David.
Okay, thank you everybody for tuning in. Our next webinar is coming on tomorrow. It's Tuesday, February 6th at 2 p.m. Eastern. I'm going to sit down with another uranium company, American Future Fuels. And reminder that we have our pre-PDAC conference approaching quickly. That's February 29th and March 1st. We expect close to 100 speakers at that conference over the 2-day event in Toronto, including Peninsula Energy and 27 other uranium companies. So have a great day, everyone, and thanks for supporting Red Cloud's webinar series.